Hello and welcome to the Business Standard Morning Show. I'm Binu Sandhu. Let's take a look at the stories for the day. Citing elusive consensus and possible discrimination against developing economies, India has decided to stay out of the trade pillar of the United States-led Indo-Pacific Economic Framework, or IPEF. Given that India is currently negotiating trade deals with the UK, Canada, and EU, is the IPEF decision a step in the wrong direction? Also, what does this mean for India's ambition to become a larger player in global trade? Find the answers in today's segment.
The Indo-Pacific Economic Framework, or IPEF, was formed jointly by the US and partner countries on the sidelines of the Quad Summit in Tokyo on the 23rd of May this year. IPEF is an important part of US President Joe Biden's strategy to counter growing Chinese clout in the Asian economic sphere. With that goal in mind, the first in-person ministerial meeting of the 14-nation bloc took place in Los Angeles last week. India decided to join three pillars of the IPEF. These relate to supply chains, tax and anti-corruption, and clean energy. However, it has decided to opt out of the trade pillar for now. Commerce and Industry Minister Piyush Goyal cited the lack of a broader consensus on issues such as environment, digital trade, labor, and public procurement as the reason behind the decision. Stating that the final contours of the framework on trade were yet to emerge, Goyal said that India was yet to ascertain what benefits member countries would derive, and whether any of the conditions, for example on the environment, might discriminate against developing countries. The minister also pointed out that India was in the process of firming up its digital framework and laws, especially on privacy and data. According to Goyal, while India would continue to engage with IPEF on trade, it would wait for the final contours to emerge before finally associating with that particular pillar. Apart from India and the US, the 12 other members of the IPEF are Australia, Brunei, Fiji, Indonesia, Japan, Korea, Malaysia, New Zealand, the Philippines, Singapore, Thailand, and Vietnam. All the other member nations have joined IPEF's four pillars. The IPEF partner countries represent over 40% of the global economy. The IPEF has four pillars. The first is supply chain resilience. The second involves clean energy, decarbonization, and infrastructure. The third deals with taxation and anti-corruption. And the fourth one is fair and resilient trade. The US is also seeking to include issues like the cross-border flow and localization of data under the framework. According to a February report by the US Congressional Research Service, member countries have to sign up to all of the components within a particular pillar, but do not have to participate in all the pillars. The Fair and Resilient Trade pillar is being led by the United States Trade Representative and includes digital, labor, and environment issues with some binding commitments. However, the IPEF does not include market access commitments such as lowering tariff barriers. IPEF is the first plurilateral deal that India has agreed to join after exiting the Regional Comprehensive Economic Partnership, or RCEP deal in 2019. The decision to opt out of the trade pillar for now may make sense since it is possible that India is not adequately prepared to handle negotiations on labor, environment standards, and digital trade. After all, domestic regulations in all of these areas are yet to reach a level of maturity. But there is need for a nuanced view because while India's domestic limitations may have driven its decision, there will be an impact on how member nations, especially the US, view it. Also, the impact of the decision on India's ambition to be a part of the global value chain needs to be looked at closely.
I think it is consistent with India's stand, which it has been taking, that non-trade issues like environment and labor should not be brought into the trade arena, and they should be discussed in depth in their respective fora. There is a tendency in various bilateral agreements also of course, of which India is not a part, to bring in an indirect way market access through labor and environment issues. So that is what India is skeptical about, is wary about, and India is just waiting and watching. India is not out of the trade pillar. India is not in at the moment. For the time being, India is keeping out, which is not going to damage its, stance or its advantages in the long run. There is this big question looming in the background as to whether IPEF on the trade aspects is TPP, Trans-Pacific Partnership 2, in a new incarnation.
Withdrawal from IPEF, the trade pillar in particular, is not going to be seen very kindly by our trade partners. That's my feeling. The basic intention of bringing IPEF on, that is the US's intention, was to secure market access for itself and, of course, its close partners. From a national perspective, yes, India doesn't have the strength to go along with market opening or conceding ground in all these areas. We still want the policy space. But the first step is something that we must do domestically. We must actually, find out, and I think that scoping exercise has not been done, that how far can the domestic constituents, for instance, agriculture, how much of liberalization can agricultural sector tolerate at this point in time? There needs to be a consensus first, then go on to the bilateral agreements and then to Omega regional. This is contradictory. You can't be part of global supply chains because global supply chains are dependent on trade. We've always been arguing that in order for India to be a part of these supply chains, India needs to liberalize.
While the decision may be the right step as far as India's domestic sensitivities are concerned in the short term, there is also a counter-argument when it comes to how competent the country is in negotiating on complex trade issues. Remember that at present, India is negotiating trade deals with the UK, Canada and EU. It has also agreed to including chapters regarding new generation trade issues.
EU is not a single country. It has 20 odd countries and they all have a say in the negotiations. So it is a very complicated negotiation which takes place when the EU is on the other side of the table. It is not to say that IPEF is going to be much more complicated than the EU agreement.
With this decision, India has closely followed its established stance on issues such as labor and the environment when it comes to trade negotiations. From that point of view, opting out of the trade pillar is the right step, albeit in the short term. What remains to be seen is how it will navigate complex trade negotiations in the future with regard to both IPEF and FTAs, given its ambition of becoming a major part of global value chains.
Staying with international trade, India is one of the largest producers of fruits and vegetables, but it has long been struggling to ramp up its exports, where smaller countries like Thailand are way ahead. Our next report explains why.
India is one of the biggest producers of fruits and vegetables of all kinds of variety. It ranks second in fruits and vegetable production in the world after China. However, India has been unable to use this massive production to its advantage through exports. The country remains a marginal player in the global fruit and vegetable market, and its share is just 1%. For instance, India produces half of the world's mangoes, but Thailand and Mexico dominate the export market. Similarly, India is the largest producer of bananas, but it is not even among the top 10 exporters. International trade of fresh fruit and vegetables represents only around 7 to 8% of total global production, but it still ranks among the most valuable crop and livestock commodity groups. In 2018, the global export value of fresh fruit and vegetables was $138 billion, only behind meat in agricultural commodities. According to the Agriculture and Processed Food Products Export Development Authority, India exported fresh fruits and vegetables worth 11,412 crore rupees in FY 2022. The processed fruits and vegetables exports, meanwhile, stood at 12,858 crore rupees. In April-June of this year, India exported fresh fruits and vegetables worth 5,506 crore rupees, up 8.6% over last year. Grapes, pomegranates, mangoes, bananas, and oranges account for the larger portion of fruits exported from the country, while onions, mixed vegetables, potatoes, tomatoes, and green chili contribute largely to the vegetable export basket. Major destinations for the Indian fresh fruits and vegetables are Bangladesh, UAE, Nepal, Netherlands, UK, among others. This shows that India's fresh fruits and vegetables exports have largely been to neighboring countries or those that are nearby. According to the Food and Agriculture Organization of the United Nations, global fruit and vegetable trade has more than doubled between 2000 and 2018, but India did not capitalize. Fruits and vegetables trade depends on the quality and freshness. For fruits and vegetables to be processed and exported, world-class logistics and infra ecosystem, along with pre-harvest and post-harvest measures, need to be in place. India lags in developing a robust and vast network of cold chains, cold storages, refrigerated transport systems. According to a study in 2017, stringent quality norms in importing countries have hampered India's exports. Other studies have documented India's woes with post-harvest losses due to the poor storage and infrasystems. According to a reply to Parliament in 2019, India's post-harvest losses of fruits and vegetables is anywhere between 4.58% to 15.88% every year.
Our population itself is very large and we are the biggest consumer of our own products. In fact, the total intake fruits and vegetables is less than what is recommended average daily intake for nutrition purposes. Secondly, our exports are not very good nowadays because most of the countries, although the tariff barriers are coming down, they are putting up other barriers like phytosanitary regulations, which are very strict. And mostly Indian exporters, Indian farmers are not adhering to the international standards of pesticide spraying and all that. So that is becoming a big problem, and everyone is now very conscious of their own public health problems. And all the particularly European countries are making very strict regulations for pesticides which are not in use in Europe. They don't even allow it. Even they're going down to zero level, detectable level of pesticides. That is the other thing. And a third reason is that transportation from the growing areas to the gateways, whether it is ports or airports, that itself is very troublesome. It takes a long time, and we don't have refrigerated vehicles. We don't have good refrigeration systems. Therefore, there is a lot of loss of quality.
Pavanex Kohli, former CEO of National Cold Chain Development Authority, told Business Standard, as fruits and vegetables don't have big saleable life, there is a need to reduce the time taken from farm to fork, which can only be done through pack houses near fields, reefer vans for quick and efficient transportation, etc. A study by NCCD conducted in 2015 found that India is woefully short of modern storage infrastructure required for transporting perishable items. Experts say if India has to improve its share in the international market and become a sizable player, we need to improve phytosanitary practices and improve the quality of cold storage transport systems.
the world's second largest rice producer, followed by China. But last week, the government imposed export duties on various grades of rice. Analysts expect that this protectionist measure will harm the profitability of rice mill companies in the near term. However, healthy rice harvest and sound fundamentals are expected to override negative sentiments in the long haul. Let's find out how.
Last week, the government imposed 20% export duties on various grades of rice like non-basmati, unmilled, semi-milled or totally milled and husked brown. A blanket ban on broken rice too was imposed as domestic supplies dwindled after below-average monsoon season. However, parboiled and basmati rice were exempted from export duties. With this, India, which accounts for 40% of the global rice trade, stands to lose its world's market share to rice-producing global peers like Thailand, Vietnam, Pakistan and Myanmar. India exports rice to at least 164 countries. Iran was the biggest overall importer of Indian rice in FY22, accounting for $855.7 million. China was the biggest recipient of broken rice in FY22, which accounted for $480.3 million. Therefore, analysts expect rice exporting companies to face the heat in the near term.
Earlier wheat also there was banned. Now there is some amount of, protectionism kind of steps being taken. These are all momentary. I don't think these are long-lasting ones. So if you are invested in some good, strong, sound, fundamental companies, then I think it makes all the more sense if you are a long-term investor to stay invested instead of, trying to react on every news flow that comes in from the government side.
From an investment viewpoint, analysts suggest investors to avoid rice mill stocks for another quarter.
Now things are getting depleted, so rice stock, I will wait for 1 quarter of correction, then I will buy. And there are many things which are doing good. Why to put money in this rice stock or commodity stock? Now mainly connected with agriculture, because till the Russia-Ukraine war goes, we will have a lot of problem and companies are not going to make good profit.
On the bourses, shares of LT Foods, Kohinoor Foods, Chamanlal Sethia Exports have declined in the range of 1% to 10%. In comparison, frontline indices Nifty 50 and the S&P BSE Sensex have gained nearly 1% each during the same period. As regards today, India's inflation numbers and macro data will guide markets today. Globally, US inflation numbers, UK unemployment report and OPEC's monthly report will also be tracked. Rupee movement, FII flows and crude oil prices will continue to steer investor sentiments on Tuesday.
Did you know that you can click a picture of any item and search for similar products on the web? People are using visual search over 8 billion times a month. Here's more about it in this segment.
Visual search is just a new way of searching for products on the internet by using an image rather than the traditional method of typing keywords. For instance, if you saw a new Nike Jordan shoe with a specific color on a social media platform, but don't know exactly how to describe it in words, you can visual search and find the related matching product by uploading the screenshot. In this case, the visual search saves a lot of time and offers quick results. Visual search has been around for many years and was built into social media and e-commerce platforms like Snapchat and Amazon. But it is gaining popularity now. According to a survey by an artificial intelligence company a few years ago, 62% of Gen Z and millennial consumers sought visual search capabilities more than any other technology. Alphabet chief Sundar Pichai said people are using Google Lens to conduct visual searches more than 8 billion times a month. There are over 600 million visual searches on Pinterest every month. A successful visual search engine requires machines to not only detect but also recognize specific objects in the image to understand what the customer actually wants. And this is where the power of artificial intelligence and machine learning helps. This technology is mostly employed by e-commerce players to improve the shopping experience of consumers. In India, Flipkart and Meesho have employed visual search technology. For categories such as fashion, jewelry, home decor, and beauty products, images play a key role in influencing decisions and add a lot of convenience for customers. For the last few years, the visual search market has also made big strides in other fields as well, such as aviation, forestry, automotive OEMs, and electronics. There are also use cases in security screening, baggage scanning, and navigation systems. The global visual search market is projected to surpass $14,727 million by 2023, growing at a compounded annual growth rate of 9%.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
In April, Google had announced the launch of multi-search which uses both text and images for improved search. That's all for today. For more news and analysis, please log into our website www.business-standard.com. And we'll also be back tomorrow morning with more. Stay tuned and thank you for watching.
For more news, views and updates, subscribe to Business Standard on Google Podcast, Apple Podcast and Spotify. Also follow us on YouTube, Vimeo, Instagram, Twitter, Facebook and LinkedIn.